Ja, ein herzliches Willkommen. Ich begrüße Sie zu unserer heutigen Portfolio Manager Konferenz. Mein Name ist Florian Koch. Ich bin Senior Investment Analyst bei Scope. Wir wollen uns heute Dividendenfonds näher anschauen. Im letzten Jahr haben einige Unternehmen ihre Dividendenzahlungen stark reduziert oder sogar ganz ausgesetzt. Für dieses Jahr haben viele Anleger die Hoffnung, dass die Auszahlungen wieder im gewohnten Maße aufgenommen werden. Wir wollen daher schauen, ob sich Fonds mit dem Fokus auf Dividendenaktien wieder lohnen und blicken insbesondere auf die Region Nordamerika, da sich hier besonders viele Unternehmen finden lassen, die schon seit Jahrzehnten Anleger mit starkem Dividendenwachstum überzeugen. Unser Gast ist heute John Weavers. Er ist Fondsmanager bei M&G und managt eine amerikanische Dividendenstrategie. So, good morning, John. It's nice to have you with us. Could you please give us some information to your position and M&G in general?
Good morning, Florian. Good morning, everyone on the call. Thank you very much for joining me today. My name is John Weavers. I'm the manager of the fund you will hopefully see the title of on the screen, the M&G North American Dividend Fund.
Okay, John, thank you for your short introduction. Before we start with our topic today, I want to ask you a more general question, I would say. More and more people are saying dividends are the new interest. So would you agree to that statement?
Thank you, Florian. I really like this question, actually, as a kind of general introduction to the fund and what we do. I think if you look at the first slide here, there's really 3 slides in this presentation that are really going to capture what we try and do on the fund, the M&G North American Dividend Fund. And this is the first of them. To your question, a lot of people over the last 3, 4, 5 years have really been looking around trying to replace the interest rates that you used to get on government bonds with dividends of good corporate companies. But there is a very high amount of risk going forward that these companies might be bad investments. What you see here on slide 3 is 2 ways of investing for dividends in a stock market. In light green, you see that traditional high yield sort of company that investors have been flocking into over the last few years to try and replicate interest rates. And this is very much not what we do on the fund that I manage. We are not looking for high yield companies just for their yield. We are looking to generate a very attractive total shareholder return for clients through investing in another form of dividends. Specifically, the very light blue bars you see on the chart here, where there is strong dividend growth associated with the investments as well. What we look for on my fund is companies that pay a good yield, still a yield premium over the market, still a very attractive dividend yield, but not the very highest yield that you can find. And the compensation, the reward that we demand for giving them that lower starting yield is that they have to have the ability to grow that dividend to us over time. And critically, they have to have the ability to grow that dividend out of becoming bigger companies themselves. So I always say we're not looking for companies that are going to take their payout ratio from 10% to 30%. We're looking for companies that are going to take their earnings per share from $10 to $30, and out of that much larger profit pool, pay us as investors a significantly larger dividend per share. The reason we do that, the reason why this gets around the risk to dividend as interest rates is twofold, and you can see both of them on the screen here. Firstly, if you get this strategy right, in this example you see on the screen, you don't have to wait too long until the dividend streams are broadly the same. But really, what we're looking for is to get this strategy right, get this dividend growth right over a number of years, 4, 5, 6, maybe even 10 years. And again, you can see on this slide here, if you achieve that, this company will be paying you a dividend per share of 8, 9, 10 percentage points in the medium term. And what is likely to happen, anyone who's ever followed the stock market knows, what is much more likely to happen is that the share price will go up alongside that. That rising dividend stream over time will push the share price up, will create a natural rising upward pressure on the share price, and you will get a very attractive capital return alongside your dividend return as well. So this is a very much a total shareholder return focused fund that aims to use the power of dividend growth to generate excess and very, very attractive returns for clients, alongside giving you that lovely income stream that can be used to replicate and replace interest rates. Now, if we move on to the next slide, you'll see why we're so confident and why we think this strategy works so well in the United States of America. We haven't just sat back and come up with this strategy and then launched funds around it on its own. There is a huge amount of empirical evidence to support the idea that this strategy works in practice. And that's what I'm going to walk you through on this slide here. If you just ignore the two right-hand bars for now, just look at the two left-hand bars, what you see here is the market return, the S&P 500 market return over the last 25 years compounded. So you see about 7.8% capital return, just over 2% dividend on top to give you that blue bar, that lovely almost 10% return compounded every single year over the last 25 years. Now, it's always nice to me to running an American-based product to sort of have a wonderful wealth creation machine as a starting point, this wonderful return from the S&P 500 as a whole. But really, what I want to call out here, what's relevant for what we're about to talk about, is that the way the market generates this return over time is very, very much to do with the capital side. About 80% of the total return coming from capital, or coming from, share price appreciation, with dividend being about 20% on top. Now that split is very, very unique to the American stock market. If I was to show you the capital to dividend split for pretty much any other major stock market in the world, Europe, even most emerging markets, the portion that comes from dividends is much, much higher. So there's something very unique, very specific about the US stock market, which means that it's a growth market. There's a lot more of the return that comes from capital growth. What that means is that any strategy that focuses on trying to maximize the benefit of this wonderful stock market has to have some idea and has to have some concept about how to unlock that capital return side. And we think that's what our focus on dividend growth really offers us. If we move then to the two right-hand bars, I said this strategy has a very strong track record and a very strong tailwind behind it. This is what we see here. We track what we call our US dividend achievers. This is a set of businesses, about 130 businesses with a 25-year or longer track record of increasing the dividend every single year. So I'll say that again, 130 businesses, 25 years or more of increasing the dividend every single year. And we use these because we think, they most appropriately match up with what we saw on the last slide with those light blue bars, where the dividend goes up every single year at a meaningful rate. The performance of these businesses over time, if you can find them, if you can get them right, is absolutely staggering. Just the capital return, so just that purple bar, that's been well in excess of the market over the last 25 years, giving you about 150, 200 basis points per annum outperformance. But what we really want is this lovely pink bar on the right-hand side. When we think about the dividend as well, when we think about that 250, 300 basis points of dividend yield that goes back into your pot, into your wealth pot every single year, is reinvested good years and bad years. So even when the market's down, you're putting more money to work in your wealth pot. That's where you get that lovely pink bar on the right-hand side, the 400 to 500 basis points of annual outperformance over what was already a very, very attractive starting market. That's what we're going for. That's what we think we can achieve if we get this strategy right. Clearly, the US dividend achievers is the subset we show here is reasonably backwards looking. That is not what we try and do, as we'll see later. We look to be forward looking to try and find the next generation of these companies. But if we get it right, this is the evidence to say that these sorts of companies meaningfully outperform over long, long periods of time. And if we go on to the next slide, just before I pause and give you a chance to catch your breath, this is the second of those three slides I'd really like you guys to remember. It's what does that 400 to 500 basis points mean to you as end clients in terms of wealth creation over this time period? And you can really see in dollars and cents, $1,000 invested in the market 25 years ago, that's the purple line at the bottom, that will be turned into $10,000 over this 25-year period. Just the capital return of our achievers, so just that 150 to 200 basis points outperformance, that's worth about 50% more in your wealth pot at the end of this 25 years. But really what we're going for, as I said, is that 400 to 500 basis points from the pink bar. That'll be worth $30,000 at the end of this period. So multiples of what is already a very attractive total return from the market. That is the key point. There is a lot of potential for this strategy to generate huge amounts of excess value and wealth for end clients over a reasonable time period. And I always say 25 years is a very long time, but it's by no means a lifetime. It's kind of half of most of our working careers. It should be well within our concept of what we think of a reasonable time frame to put money to work in the market for.
Okay, thanks, John. At this moment in time, we just want to give some parameters to the fund. I switch to German. Der Fonds wurde 2018 aufgelegt. Das Fondsvolumen ist derzeit 170 Millionen Euro. Benchmark ist der S&P 500. So, John, what is the reason that investors are investing in the fund? Is it that they want to have a constant payment stream, or is it because of other reasons?
Yeah, I think it's a dual reason. So number one, this strategy is set up to outperform the market, full stop. That is our primary intent. As I said in the last couple of slides, we know there's this huge, powerful tailwind behind dividend growth investing that works in the US market. But alongside that, you will also get a wonderful income stream as well that's reasonably secure, reasonably robust. The US market as a whole has very robust income, and this fund obviously focuses even more on companies that are going to consistently and meaningfully grow those distributions over time. So there's a real dual attraction to the fund for a lot of clients, and I think we're really starting to see, particularly as you said, in a more uncertain interest rate environment, a lot of people really appreciate the consistency and robustness of that dividend stream alongside a very attractive capital return as well.
But is this a reason why the distribution frequency is quarterly, or is it because of other reasons?
That's more just a function of how income is paid in the market. So income is paid in the US market generally quarterly by companies. So we just matched it up with that. There's no client pull from that distribution payment schedule.
Okay. Then I would say we move to the investment process. So, John, could you please tell us what are the different steps of the investment process? And there are nearly 4,000 stocks for the region North America, but how do you identify the best dividend payers? And what are your key parameters for this?
Of course, that's a great question. And hopefully slide 9 can help us understand how we go about the process. We know we have this really powerful tailwind behind this strategy. The most important thing we do on the fund, therefore, is to try and find these businesses that we think can deliver on that growing distribution over time. We do have a kind of top-down framework which we use, which I'll talk you through in a second as well. But really, it's important to say the majority of the investment decisions we make, the majority of our investment process is set up to, first and foremost, find the right companies that we would like to own at some point, and then secondly, to buy them at the right price. So we're not valuation agnostic or valuation irrelevant, but we believe very strongly that the right company is a little bit more important than the right valuation, and that if we buy a good high quality business that delivers on what we want on the dividend side at maybe a little bit too high a price, that the quality of the business will probably get us out of trouble. Whereas if we buy a lower quality business at a cheap looking price, if something goes wrong, then we'll probably end up being in a little bit more trouble. So this is why we have this 3-stage process set up as it is. It's focused on finding those right businesses first and then buying them at a good valuation second. There is a very replicable 3-stage investment process we go through here. As you called out at the start, there's 4,000 investable stocks for us in America and Canada. So we need to focus that down quite quickly onto the ones we eventually want to own. We do that starting on the left-hand side with a very simple quantitative screen. This is a very high-level screen that essentially removes companies that we will never be able to invest in, that will never meet our investment criteria early on. So good examples here, companies that don't pay a dividend, a very obvious example of a company that aren't going to be relevant for this strategy, companies that aren't big enough or liquid enough to put a significant amount of investor capital behind. And then also we have a very initial ESG cut here. This is an ESG integrated fund. So we have an initial ESG exclusion screen here. So we don't invest in UNGC violators or thermal coal businesses or tobacco businesses or a whole host of other SKUs that you see listed on the screen there. Just that screen, it's not the most complicated one in the world. Just that screen cuts down the investable universe for us from about 4,000 stocks to about 2,000 stocks. And that's when we move to the second box in the middle. This is where we spend most of our time. This is where we do a lot more qualitative analysis. This is about identifying stocks that we would like to own at some point. And really, we're looking for 3 or 4 things in this box here. First and foremost, we're looking for very high quality businesses. And quality there is defined by returns on capital. We want businesses that for every dollar they invest in themselves generate a lot of money back from that investment. But we also need the second bullet point there, you see, which is a very big reinvestment opportunity. There are plenty of very high return on capital businesses that can't deploy the capital at those rates and therefore can't grow very, very attractively. I always sort of say, good example of this is Coca-Cola, where they have fantastically high returns on capital, but the average American drinks between 2.5 and 3 cans of carbonated soft drink every day. They just don't have a huge amount of opportunity to sell more product to their core consumer base. So we want that lovely high return on capital and a very obvious reinvestment opportunity. The third thing we look for is a dividend commitment. We don't talk about it so much, but as we saw right at the start, that dividend growth is the anchor that we use to know that if the dividend is going up every single year and the share price isn't moving, at some point, the rising power of that dividend stream is going to put upward pressure on the share price and start to get the share price moving in the right direction again. We want to know that if we're right on our first 2 bullet points, this company grows very attractively at high returns on capital. We want to know that we as investors are going to get that increasing dividend alongside it. And then fourthly, as I said, we do integrate ESG quite aggressively and quite meaningfully these days on the product. We look for a whole host of sustainability and ESG factors at our qualitative analysis stage, both to try and understand any potential risks that would come through in the future, but also increasingly and perhaps more excitingly for thinking about value creation and alpha generation. We're looking for areas where companies can use high ESG SKUs to generate superior investment returns for us. And what we mean by that is either more robust cost base or a significantly outsized growth opportunity that they can go after. Just this process, as I said, this is where we spend the majority of our time in this middle box. That leaves us with about 200 stocks. And really, that is what we term our investable universe. Really, that's what we use to pick the end fund that you see on the right-hand side there. We like to think that having done all the work to get to those 200 stocks, when we get a valuation opportunity, this is where we start to think about valuation. When we get that valuation opportunity, we can move quickly and in a high degree of size to invest behind these ideas. And really, that's the end fund then is 40 to 50 stocks, pretty concentrated, with position size determined by our conviction in the individual risk-reward opportunity.
Okay, thank you very much. We also want to speak about a concrete example of your portfolio. So on the next slide, we see the different sources of your fund, and you brought us MasterCard as a good example for a rapid growth company that is also an excellent dividend payer. So I learned at university that most rapid growing companies do not pay high dividends. Their argument is usually the internal growth rate compensate investors in a better way. So only if there is no other opportunity to boost internal growth, they give their investors the cash back in form of dividends. So is this not true anymore? And could you please tell us why MasterCard is in your portfolio?
Perfect. Okay, there's a lot to cover there. Maybe if I could just set the scene a little bit first with this slide before I talk specifically about MasterCard. But I will answer your question, I promise. As you call out here, we have a number of examples. This is our top-down overlay on how we manage the fund. What we are trying to do here is segment the fund to make sure that it isn't just a style-based fund which only outperforms when value works or when growth works or when quality works, for example, and really gives investors the benefit of this dividend growth tailwind and a variety of different markets. We segment, or we draw our individual stock opportunities from three distinct buckets: quality, assets, rapid growth. And if I just talk you through them quickly here, it'll hopefully help you understand how it works in practice. Quality is very obvious. It's kind of probably what you would usually think of when you think of a dividend fund. Big, stable companies, pay a reasonable amount of earnings out as income, grow that dividend stream consistently over time. Company like Mondelez here, good example, but also PepsiCo, Johnson & Johnson, businesses like that that are easy to find, usually quite difficult to buy at an attractive price, and crucially, they all outperform or underperform at the same point in the cycle. There's nothing wrong with that, but we wanted, as I said, to be a fund that didn't just have a huge, heavy style tilt and that allowed us to outperform in a variety of different markets. And that's really why we have the two other buckets, especially the assets bucket. This is best thought of as our cyclicals bucket. So it's companies that have a very strong tie into the macro cycle in their business model. Union Pacific, a good example here, big North American railroad, where they've got a lot about them, wonderful stock-specific growth opportunities. The total amount of freight moved by truck in the US is still about 70-75%. So there's a huge opportunity for rail to get involved in that and move it more cheaply in a more environmentally friendly way around the States. But fundamentally, they still have this big tie into the macro cycle. If there's an economic recession, they will see big top and bottom line hits to their earnings. How do they compensate for that in terms of what we care about, the dividend? You see on the right-hand side there, they'll grow it very nicely. The economic downturn might hit and then it's held flat or it grows very little for a year or two. Because we've done all that work in our first two boxes, as we saw on the prior slide, we know that when growth returns, their dividend commitment is such they will continue to grow that dividend very, very nicely. We can often invest in that flattening off period and make a very, very attractive return. There are a whole host of these companies that we find in the States that just because they're a little bit more economically sensitive doesn't mean they're not very, very good businesses for dividend growth over a medium to long-term time horizon. These sorts of businesses, about 25 to 35% of the fund, they're probably about 50 to 60% of my time. They take a bit more managing. They tend to need a little bit more maintenance because they're a bit more volatile, but they can, as we are currently seeing, offer huge amounts of return to the fund in markets like we're currently seeing in the US right now. Final bucket is rapid growth, where, as you said, you called out MasterCard as a good example of this. These are going to be very stock-specific businesses that have something about them that's going to allow them to grow very, very quickly for a long, long period of time. There's about 20 to 30% of the fund capital in these sorts of businesses. It's a significantly higher piece of a US fund than it would be of a global fund or a European fund, because there are more of these sorts of business opportunities available in the States. Good opportunity now to talk about MasterCard and sort of what this can offer us as investors, and why it's a very good example actually of why this strategy works so well in America. Maybe if we slip onto the next slide, and I will start at a very high level with the MasterCard investment case, but I will finish this example by talking about the fund and the fund opportunity. So please, if anyone has heard this investment case before, don't switch off, because this is less about the individual example as it is about why this strategy works in America and what this strategy can offer you in terms of capital and income growth and income return over any sort of medium time period. If you think about MasterCard and what they do, most people know MasterCard, Visa, they own the payments and processing networks that sit between you in a shop, putting your card in the machine, tapping on the machine to try and buy a good or a service, and your bank where all your money is, and you enter your PIN or you sign your credit card, whatever it might be. A little signal is sent along their processing network to the bank. Yes, the money is there, authorizes the transaction, comes back and allows you to walk out of the shop with your whatever you've bought, and it all happens almost instantaneously, so quickly that we don't even know about it. And for that service, MasterCard itself takes a very, very small percentage of the total transaction size as a revenue. Now, clearly, this is, the last 10 years, the last 20 years have been a wonderful market environment for any business like this. There's been a huge shift from cash payments towards card payments, and now digital and mobile payments again in the future. What you see on the left-hand side on this slide here is the total amount of money that has been spent on non-cash payments in the global economy by consumers over the last decade. And you can see, there is almost no global financial crisis. Even its bottom left to top right, there's been a very, very powerful shift in their favor, and they've generated a huge amount of growth out of the back of that. Brilliant. That's all very well and good. Why am I showing you this? This would be our starting point for the first of those bullet points that we spoke about earlier, where we can use this data in conjunction with analysis of their investments to work out the returns on capital these businesses have generated over a long, long period of time. But we also said high returns on capital alone weren't enough. We also need a very strong reinvestment opportunity as well. And that's what you see on the right-hand side of this chart. This is the percentage of total payments that have been spent on non-cash means over the last decade. And yes, it has increased. It's gone from high 20% to low 40%. But the key point is there is still a massive amount of opportunity for this growth to continue into the future. The highest countries in the world, sort of UK, Canada, Sweden, etc., somewhere in the 75–80% penetration rates. There are some big European economies, Italy, Spain, where the penetration is a lot lower. It's sort of 25–30%. So there's a big opportunity to continue for these businesses to continue to grow and reinvest. And crucially, it can come just by moving certain developed Western economies up the same development curve that other parts of the world have experienced. So very, very high returns on capital, huge reinvestment opportunity in front of them. What was the third thing we looked for? If you skip over to the next slide, you will see it was the dividend investment, the dividend commitment that these businesses generate. Now, normally, when I give this presentation, I have to click it myself. So please imagine that you can't see the big red box for just 5 seconds. What you are seeing here with the green bars is the dividend per share that MasterCard has paid clients or investors every single year since it's been a listed business. And you can see it grows slowly at first, but over the last 8, 9, 10 years or so, very, very rapidly. So proving that point that we wanted, out of bigger business comes a much bigger dividend. It's not about the payout ratio. It's about a growth in the business driving up that dividend. Now, I said I would tie this back to the fund and the fund strategy and why we do what we do. Let me do that by referring to the numbers you see in the little box on the left-hand side there. If you'd been good enough, smart enough, lucky enough to buy shares in this business the very first day it IPO'd in May 2006, you would have bought a business that yielded somewhere around 90 basis points per share. The highest this company has ever yielded was 97 basis points per share back in the depth of the GFC in March 2009. And yet, if you had bought stock in this business on the very first day it IPO'd, today, the dividend per share that you would be getting would be equivalent to a dividend yield on your investment price of 44%. And that number will go up about 20% again this year. So next time you see me speak, it will be over 50% you would have received on your initial investment. But as we said, this company has never looked like a particularly high yielding dividend company. It's never yielded more than 1%. It's never been anything that you would see on your screen if you screen just on dividend yield alone. And yet it is first and foremost given you a massive, massive amount of income. Secondly, it is better than any income you could have achieved if you had screened just on dividend yields. So there are no companies that yielded 4, 5, 6, 7% on your initial starting yield back in 2006 that have grown that dividend to such a degree they're giving you an equivalent income stream today. So not only would you have missed out on this wonderful income opportunity, you also would have put yourself in an inferior income stream selection by focusing on yield alone. So what we are saying is this shows you this strategy can give you and does give you meaningful income streams. You might just have to wait a year or two, but the dividend growth is such that you will get meaningful amounts of income on your initial investment at some point in the future. And yes, MasterCard is a very good example of this. That's why we're showing it to you. That's why we've picked it. But if you move on to slide 13, please, Florian, you will see that the reason we get so excited about this strategy and the reason why we think this strategy works so well in the USA is because that this is not a unique situation or a unique business by any means out there. There is a huge spectrum of consistent dividend growers that we can invest in. You see on the left-hand side here, this is companies with at least 10 years of consecutive dividend growth that now goes through two of the worst dividend cut markets in the GFC and now COVID. There's still almost 300 of these businesses in America. There's another 50 or so in Canada. Compare that to here in Europe and Japan and Asia Pacific, where there's less than 100 put together. And you want to get really excited. Of those nearly 300 businesses, about 40% of them have grown those dividend streams at double-digit compound rates over that decade period. It's a bigger, deeper, broader market and broader investment opportunity that also grows significantly faster than anywhere else in the world. That allows us to the MasterCard example, give you investments that not only grow very, very quickly, but also end up returning a very, very meaningful income stream to you in the future.
Okay, thank you very much. This is a very impressive chart, I would say. But at this point, I would say we just move to another topic of your fund, which is ESG. So you are also considering ESG criteria in your investment process. So here we see some stocks that are not in your portfolio because of different reasons. So my first question is, do you use external providers for the ESG rating? And secondly, how often is the portfolio checked for sustainability ratings?
Yes, thank you for that. Thanks for calling this out. It's very important to what we do now. I guess I wouldn't say it's always been front and center in what we do, but over the last 2 years, we've spent a lot of time moving the fund towards a position where we're both extremely happy with the quality of our existing holdings and also extremely excited about the ESG integration we have and the tools that we currently use for new investments from this point going forward. Essentially, there's two ways we try and use ESG integration on the fund. The first of which you see here, as you say, screening and finding hidden risk factors and things that we think are troublesome about a business that you wouldn't see just by analysing the financials, but which have significant potential implications for both society and even the financials longer term. So a good example of this, a business like Altria that is involved in tobacco, where longer term there will be potentially meaningful negative consequences to the business by increased charges to their core business model. Constellation Brands, another example we sold very recently, where it's a wonderful looking business from a financial point of view. It has a very high growth potential in front of it and a wonderful dividend track record. But dig a little deeper below the surface, and there are a whole host of risks around water rights in a very sensitive part of the world where they have their manufacturing facilities that are ultimately potentially going to result in quite large fines for the business. So first and foremost, the very easy way I think to use ESG is to run exclusions, and then secondly to kind of dig a little bit to try and find hidden risk factors. That's one thing we do. We do use third-party rating systems to help us with this analysis, but we also have a very outsized ESG offering internally now that we are building. We've hired quite a few people at M&G over the last probably 3 or 4 years now to help build this out for us. And all of our research team, our sort of 50-person strong research team, is very competent and very capable in terms of ESG analysis, and their specific sectors. So they're split up on a sector specialist basis. They help us with specific ESG integration within their spheres. All this work has been, as you say, rewarded with a nice external rating, AA. It's actually gone up to AAA this last week from MSCI. But there's also another way of using ESG integration, which I'm almost more excited about, which is the next slide. So if we talk there, we can talk about Mondelez. This is what I think we're really hoping to use our ESG integration for going forward, which is to find businesses that not only do good for the world and not only have got their arms around the potential hidden costs and hidden risks to their business from potential negative outturns to society. So they've got their arms around their carbon footprint, they've got their arms around the water use on their supply chain, they've got their arms around any other specific tools and risks to their business. But they've then used that data and they've used those processes to come to a better, more financially beneficial place for us as investors as well. And I think Mondelez is a really good example of this. For those that don't know, it's a huge global snacks business. It makes chocolate from Cadbury, it makes Oreos, it has Trident gum, it has a whole host of snack-related food products, of which a big cost input is cocoa. Now, cocoa is a product that is mostly grown in emerging markets. It tends to be extremely environmentally tricky because it is often related to deforestation to replace that land for farming cocoa. There's also quite a heavy social risk and some really negative social issues associated with it, particularly around child labor. Now, Mondelez has spent a decade almost trying to improve its situation there and make sure that its supply chain has none of these issues and is really robust and done in a sustainable way. Initially, they tried to do this by working with third parties, and that proved very, very unsustainable. So they eventually launched what they termed their Cocoa Life initiative, where they have pretty much brought in-house all of their cocoa production. So they've gone from a position of 0 about 10 years ago to about 70%, and they aim to be 100% sourced from this initiative by 2025. But the reason this has become so exciting for us is that they're starting to see the cocoa they do source through this product, through this initiative, is now meaningfully cheaper than all of its alternatives because they control the supply chain, because they now have clarity over it, and they can introduce best practices across their whole cocoa sourcing. They are now sitting in a situation where their cocoa production is 20% cheaper than it would be to buy on the open market. And in a very, very inflationary environment like we're currently seeing right now, they're completely immune and completely insured against that by the fact that they own these farms and these supply chains themselves. So it's really a double win. They've massively de-risked the business from potential fines and potential real negative impacts to the world, but they've also then ended up with a situation where we as investors are benefiting from a meaningfully improved cost base, and that means more profit at the end of the day, which they can use to return to us as dividends. So that's how we think about it. We're trying to be both risk aware, but also opportunity aware in how we use these tools.
Okay, so we see that ESG is a very important factor for your fund and your strategy. So I would say, so far we have only spoken about the current education of your fund, but we should also speak about the potential, or about your opinion on the potential sector developments. So last year, many companies have reduced their dividends, and many investors hope that we see a strong recovery this year. So which sectors do you prefer for the upcoming months, and what are your reasons?
Perfect. Yes, that's two very, very good points there. The US was by no means immune to the kind of pressure on dividends that we saw globally last year, but it was significantly better than what we would have seen in the UK or in Europe or emerging markets as well. There were more dividend cuts in America last year than there were in the entire global financial crisis put together. And significantly, about 70% of those cuts were to zero, whereas last time round, about 30% were to zero. So more cuts and to a much greater degree as well. That resulted in the whole market reducing its dividend payments by about 5 percentage points in America. Now, on this fund, because as I said earlier, we have a much higher focus on dividend. We tend to invest in companies that are much more robust dividend payers. We actually managed to grow our distribution to clients last year by about 3 or 4 percentage points. And we aim to do so again. We're going to grow our distribution by about 8, 9, 10 percentage points again this year, according to our estimates. So that's not a fluke. That's because we focus on businesses that are more likely and more committed to their dividend and have a higher quality to their earnings stream. Where we're currently looking right now is to try and identify the businesses and the opportunities ahead of us in a post-COVID world. The last 3 to 6 months have seen a pretty meaningful shift in the underlying market, and a few of those sort of reopening plays have done extremely well as vaccines have started to come and be administered throughout the world. Really, we think a lot of that first move has now played out. And what you need to be looking for, again, is multi-year winners that also have opportunity to earn more money and do better in a post-COVID world than they did before. And really, that's what you see on this slide here, which is a number of different themes and areas that we've focused down on. And today, I'd like to talk about 2 of them if we have time. The first of which is digital payments, sort of continuing that MasterCard discussion we had earlier. And that's around Visa, which is the second biggest holding on the fund and the biggest active weight we have on the fund right now. If you skip onto the next slide, please, you'll see a couple of reasons why we think this company is really a perfect example of what we're trying to invest in right now. Companies that have both increased structural opportunity from COVID, as well as a near-term tailwind from reopening. What you see on the left-hand side is 2 forms of payment. In blue, card not present, so that is a very good proxy for online spending. And then in green, card present and online travel spending. And clearly you can see over the last year, a pretty sizable fall off in that initial card present spending as we all went into lockdown, and that slowly started to improve over the last 6 months or so, but is still well below where it was pre-COVID. And then in blue, that online spending, which jumped up and accelerated as we all can go out and about, and then has continued to grow and actually continued to grow even strongly now as we start to lap those very meaningful drawdowns from last year. So what you're seeing here on this chart then is that this shift towards online spending has now become structural in nature. It's not slowing down. It's actually accelerating even as we lap the lows last year, and it has more difficult growth rates to try and comp on top of. You're still seeing the majority of investors spend a lot more money now on online shopping than they did 12, 18 months ago. Why is that important for digital payment businesses like Visa? Well, as you see on the right-hand side, the amount of money that gets spent over their network in a digital setting is nearly 3 times as much as what gets spent over their network on a physical setting for every dollar that's spent. So every dollar that is spent online, about 3 times as much goes over Visa's network than every dollar that you spend in the physical world. What does that mean? That growth in online is therefore opening up a massive investment opportunity, a massive revenue opportunity for these businesses. More money is going over their networks. They should earn significantly higher revenues in the future as we have structurally moved our payment methods away from cash and more towards card and online. So that structural tailwind that we spoke about earlier with the MasterCard example is still very much intact and has actually been accelerated by COVID. But they also have this wonderful near-term cyclical opportunity as well. You saw in the green line on the left-hand side, card not present travel has also fallen quite sizably during this. Travel, eating out, leisure spend was about 25% of Visa and MasterCard's revenues pre-COVID. And that is still running -70, -80% year on year at the moment. What that means is they have had this huge structural expansion in their revenue set from the move online. They also have a very powerful short-term reopening amount of revenue, this 25% of revenue that's going to come back at some point in the next year or two. It's going to leave you with a business that's going to grow significantly quicker than it has historically for the next 4 or 5 years. Currently trading on multiples the same as where it was pre-COVID. In fact, for Visa's case, the share price is almost exactly the same as it was 12 months ago. So big opportunity to take advantage of a real underappreciated COVID winner that also has big reopening and inflation appeal as well, trading on quite attractive valuations. So that's a big example of what we're trying to do on the fund right now is get these structural opportunities and have reopening exposure as well. If we've got time, and Florian, please tell me if we're running out of time, but on the next slide, you'll see another good example of this, which is our big exposure to semiconductors. And again, we think this is an area where there's meaningful cyclical upside and meaningful reopening exposure, but they also have pretty sizable structural revenue opportunities as well. What you see here is the total amount of industry revenue in the semiconductor market over the last 30, 40 years. And you can see it's very, very volatile. It's quite cyclical, but it's a consistent and steady grower over the long term. It's always paid to buy the fall in semiconductor revenue quite aggressively. We think we are currently right at the start of the next real exciting wave of semiconductor spend over the next decade, driven by a whole host of non-consumer related ventures. So autonomous cars, electric vehicles, AI, what's called IoT, the Internet of Things, which is moving semiconductor spend into the industrial space, is going to underpin a huge amount of growth potential for this entire space, as well as the more traditional consumer-orientated products that have traditionally driven it. We have a pretty large exposure to a number of these areas through holdings in companies like Lam Research, NXP Semiconductors, Broadcom, Qualcomm, that we think are going to sizably position us to outperform and take advantage of this spend. Alongside that, you can also see with the dotted line, this company is still, this business area, this industry has still not recovered its revenues from 2018. COVID actually wreaked havoc on the supply chain for the semiconductor industry. So a lot of businesses, you might have read in the press, currently have very, very limited inventory. What this means is the pricing environment is going to be very strong for the next few years. The demand environment is going to be very, very strong as those inventories are restocked and rebuilt. Plus, we're coming from a point of view, as said, on valuation, where we haven't recaptured the peak revenues yet, and valuations are mostly still trading at a discount to the market. It puts us in a very, very strong position going forward, as I said, big cyclical reopening opportunity alongside that long-term structural opportunity around the new waves of semiconductor demand that are coming.
Okay, thank you, John. So on the next page, we see the sector breakdown, which is just official information, I would say. So the investors can find this information on every fact sheet. So I would spend the last 5 minutes on the following topic, since everybody is interested to see what is the environment in the post-corona world. So what can investors expect from dividend payers, and what are the sectors you will focus on in the upcoming months?
Perfect. Well, so as we've talked through a couple of areas on the prior couple of slides and what we're trying to do. I think really that the story we're trying to tell about America, particularly with regards to income over the next year or two, is that you haven't missed the opportunity yet, and there is a dividend bonanza currently coming from America. So American companies are growing their dividends absolutely enormously this year, and we expect that to continue for the next few years. Looking backwards, this is what we aim to do on the fund. We aim to give you a fund that yields more than the market and grows significantly quicker than the market as well. Historically, we've managed to do that. So we initially used to yield about 2.5% on this fund versus the market of about 2%. So that was about a 25% yield premium. We've grown that distribution over the last 4 years by 30 percentage points, so high single digits compounded, versus the market at kind of low single digits. So we've given, delivered on our stated target of yielding more and growing that quite sizably. That's helped the fund outperform over this time period. Looking forward on the next slide, we think we're well positioned to do that again this year. So I mentioned last year, the market shrank by about 5%, we grew by about 3%, so we delivered quite sizable outperformance on our dividend commitment last year. This year again, you can see the yield is about a 22% premium over the wider market. But just as important to myself, we're growing that dividend yield at 9-10 percentage points. The market is better than it was last year, but it's still only low single digits. So again, you're going to get more income growth out of this fund. That is being driven by all of the companies we hold. It's a very consistent dividend skew across the entire 40 to 50 stocks that we hold. If you look on the next slide, you'll see that in quite a powerful form. This is all of our holdings year to date and their dividend announcements bucketed by how much they've increased the dividend. So more than 15% on the left, 5 to 15% in the middle, less than 5% on the right-hand side. You obviously want as many of those names on the left as possible. And you can see there are a huge number of businesses that we hold that are growing their dividends to us by very, very attractive rates. This is allowing us to outperform the market again this year. We think this isn't just a one-off, it's not a fluke. We think next year these companies are going to be positioned to grow their dividends again quite sizably, because most of them have incredibly strong earnings growth that's powering this dividend growth. Again, it's not payout ratio growth, it is earnings growth that is delivering this dividend growth. And really that positions both this fund and the American market to really outperform the rest of the world in terms of income and income growth over the next 12, 24, 36 months.
John, sorry for interrupting. I have just an additional question to the market environment. So since some months we see a shift from growth to value stocks. So do you see any negative consequences for the fund strategy?
Not really, no. So the reason for that is that bucket structure that we spoke about at the start. In the way we would categorize it, the shift towards value has mostly been, we have seen that in our rapid growth businesses have not done so well. Our assets businesses, our more cyclical businesses, have done very, very well, and they've more than compensated for the rapid growth businesses not doing so well. So I think it might be in the appendix, but we have a slide where we show the attribution over the last 6 to 12 months on the fund. We've made about 800-900 basis points outperformance from the assets bucket. We've lost about 200-300 basis points from the rapid growth bucket. So you can kind of see there is some small offset, but the way this fund is currently set up is exactly that. It allows us to follow valuation and to outperform in a number of different markets. And really, that's what we're doing at the moment. We have that overweight to the more cyclical area at the moment, and that's standing us in pretty good stead. So it doesn't automatically mean this fund is not going to do well because we focus on income growth. A lot of that income growth is not in the disruptors of the world or the businesses that are not currently doing well. It's in real businesses with real cash flows that are what the market is currently looking for.
Okay, thank you.
Sorry, do you have a question? Sorry.
Okay, I just want to move to the final slide. Yeah. So this is the summary for our webinar today. So maybe you can give us 3 arguments in 1 minute why the strategy is interesting, why dividends are interesting, and why investors should focus on American dividends.
Perfect, of course I can. First of all, just sort of like to finish by saying thank you to everyone for listening. Thank you for following along with me in English. My German is not so good, so I really appreciate you letting me do it in English. And hopefully, we've covered a lot of topics here today. So if there's any follow-ups on anyone would like to talk about in more detail, please feel free to reach out and contact us. Hopefully, the 3 things that you will take away from the presentation today. Number 1, this dividend growth strategy is a winning strategy in the American market. We have this wonderful tailwind behind us around dividend growth, providing a powerful support to capital return that we saw on our first slide. Secondly, the way we set up this fund is a balanced way to try and capture that. So we have those 3 buckets. This differentiates us from other dividend funds, and it allows us to outperform in not just when things are falling and dividends provide a defensive attribute, but also when things are rising and things are quite cyclical as they are now. And then thirdly, we have that 3-stage investment process. It's all about finding the right businesses first, but we have that very, very strong valuation framework we put in on the end, where we think having done all the work to find those wonderful businesses and the right businesses first, when we do get market opportunities like we're seeing now, we can move and put a lot of investor capital behind them in a pretty short space of time for the benefit of long-term wealth and value creation. So I'll leave it there. Again, for everyone for listening to me, and if there's any further questions, please shout now, Florian.
Okay, John, thank you very much for your presentation. I think we got many details for the fund and why dividends are interesting. Yes, indeed, we have one further question from the audience via the chat function, which is a question regarding Apple. So why is Apple not in your portfolio? I mean, the stock is very popular. They are paying dividends. They are from North America. So all reasons are given. So why is Apple not in your portfolio?
Yeah, it's a great question. It's a stock we follow closely. It's on our investable list. It is, as you would imagine, a very high return on capital business. We do think they've got some still very exciting growth opportunities in front of them. And as the questioner points out quite rightly, they do have a good dividend track record as well. We used to own Apple. I actually bought Apple again on the fund in March, April last year. But there's always a tension around long-term growth opportunity and valuation on the fund. And so Apple did so well last year, it more than doubled from when we bought it in about 6 months, that we just could no longer justify holding it on the valuation it traded when we had so many other opportunities of equal or better quality in the fund. So it's nothing to do with the stock itself. I still think it's a wonderful stock and a wonderful business, and we'd love to own it again at some point in the future if the opportunity came along. But particularly in sort of November time, when we eventually ended up selling the shares, the opportunity we're seeing in the payments companies and the semiconductor companies, some of which have similar drivers. So the semis businesses, a lot of them supply Apple, so you get the same end demand through that exposure. We're trading on much more attractive valuation opportunities and paying better and faster growing dividends as well. So hopefully that's clear. It was less to do with Apple as it was to do with the other opportunities we were seeing elsewhere.
Okay, I think this is clear. There are no further questions via the chat function. So I would say we just stop here at perfect timing. So thanks again to John from M&G for his brilliant insights on the American dividend payers and also on the fund. Und ich sage an dieser Stelle vielen Dank für Ihre Teilnahme an dem heutigen Webinar. Ich hoffe, Sie haben einige interessante Aspekte mitnehmen können und können sie auch für Ihre Investment nutzen. Wir würden uns natürlich wieder freuen, wenn Sie auch das nächste Mal wieder dabei sind. Ich wünsche Ihnen einen schönen Tag und sage Tschüss aus Frankfurt.